Okay, shall we get underway?
Yes, let's start.
All right, perfect. Well, good afternoon, folks. We have coined that new word, family, right? You're all family here. Glad to see you on this beautiful Southern California day where we pay the weather tax. And we were talking a little bit earlier about, boy, it's just beautiful to look out the window, get outside. And I'm glad we're here as opposed to some other places on the universe right here, right now, right? So thanks for joining us. And Daniel Medina and I welcome all participants. And we're delighted in our first workshop. This is going to be called Why Active Management. And we're delighted that one of the gentlemen we have the pleasure of working with behind the scenes is Keith Stimple, who is a senior regional consultant with AssetMark. And a lot of you have your money at AssetMark, and a lot of you had your money at mutual funds when we first met. And there are reasons why we encourage you to move from the well-known names that have a lot of brain share because they advertise to companies that have no advertisements, which mean you don't pay for that. But we look at everything. That's the real point, Daniel and I do. And so we're always looking to see where the best place might be for your money to sit. And it may be there for a long time, but we want you to understand we're always looking to see, is this the best place given your specific parameters? And that's one of the reasons that we like AssetMark, and there are larger groups of people that are behind the scenes, if you will. So Daniel are your representatives, but we're kicking the tires all over the place. We encourage you to kick the tires. So as I say, this is workshop 1, which means there is workshop 2, because we look at 2008, we look at 2022, and we will touch on these things. We're going to submit to you, there's a 1-2 punch. Please understand that last year was a phenomenal year to the downside. And by that, I mean it was the worst year in more than a decade for both stocks and bonds. And recognize that the industry, I've only been in it since 1979, has made a declaration that it's all about being balanced. And a balanced portfolio has been represented to be 60% stocks, 40% bonds. By the way, that combination got hit pretty hard last year. So what we will not do is insult you with some of the things that our industry is, as far as we're concerned, very famous for. They're platitudes, right? We learned it in our first year in the business, and repeated for how many years we've been in the business. You know the speech: buy and hold, sit and take it, hold and hope, stocks for the long term, buy the dips. It's not timing, it's time in the market, and you need more time in the market. Well, that's all true. Almost all of the time, except when we start taking withdrawals. Then it becomes a very different scenario. And we're going to paint that for you so that you can see how what we do is a work to try and keep your assets from being handed to you, no matter what the market might do. We want you to be able to say, hey, we're doing okay. We can see that to our satisfaction. We're not being overly optimistic. We're not being pessimistic. We're being realistic. We have some parameters in here to see what needs to happen to keep the money to do what we need it to do. And our first answer is active management, which we'll talk about today in detail. And on the 13th of March, please mark your calendars for noon, same time, same station, where we'll be looking at greater diversification in general and alternative investments in particular, to see how those vehicles have helped us see gains when the market has been in decline from time to time. And going back to 2019, we first said, what can we do to be more recession resistant? And we think this 1-2 punch, active management and greater diversification. So far, those are our best answers. You can count on Daniel and I to continue to look at these things because things change. So just last week, just to kind of put things in perspective, we had one gentleman, Michael Burry, you might remember him, the Big Short, right? On real estate. He had a 1-tweet declaration: sell. One word. That was it. That's all he said. At the same time, Jim Cramer, you know him on TV, he's famous. He's saying, hey, it's stocks for the long haul. It's off to a brand new ball game. Well, who knows how that's going to turn out? I don't. And it may be that 2023 could be a bear market trap. You don't know. And understand, these bear market traps, you can see 10, 20, 30% gains as the market is from peak to trough declining 80%. And by the way, from what we can see, it is not uncommon to see that time frame for the peak to trough to take up to 2 years. So people are going, oh, okay, the coast is clear. We can buy it's all good. It's safe to get back in the water. And then the bear comes around and says, nope, we're done here. And you got the head fake, and then now you get kicked in the assets. So we want to make sure that we don't have that story to try to live with. We want to make sure that you can tell your own story and to see that no matter what the market does, like I say, if it turns into Titanic, you want to be in a position where it's not that meaningful to you. So let's start, Daniel, please, with our first chart. We like charts. This one, I think everybody will like. It's simple. It's the best one we've seen. We're stealing it because when we get into question, people say, well, when I have a loss, our simple math is if I'm off 20%, I only need 20% to get back to even. So please see on the left, choose your poison in terms of the losses. And then in 1 year, what does it take as a gain to get back to even? If we're off only 10 at the top, we only need 11 to get back to even. So what do they say when you find yourself in a ditch? Stop digging. So the question is, where do you want the bottom of that ditch to be if you could set it there? Nothing's guaranteed, but we work with you, as you know, to help you determine what kind of loss can you live with, so that we're not telling you, oh, it's stocks for the long haul. No, we want to say to you, yes, your account's down 100 grand, but you said your limit for losses was 20%. This is arbitrary, right? This is completely arbitrary, hypothetical. And you're not yet at 20% in spite of the account being down $100,000. In fact, one gentleman on the call right now with us. So what do you mean? This is good news. You're telling me I lose money. I lost money. Well, look at it this way. If we're saying to you, if you said to us you could live with a 15% loss, and we see that your account's down 10%, but the market's off 20% on $1 million account. If your account's down 10, that's what, 100 grand. If your account's down 20%, that's 200 grand. And NASDAQ was off, what, 30%? When down the S&P, I believe, was off last year about 20%. NASDAQ was off 30%. So, to $1 million, where do you want your bottom to be? 100 grand, 200 grand, 300 grand? That's a good question. We may never reach your goal, but it's good to have a goal. At least we have something to talk about as opposed, well, my account's down. That's the nature of investing. That's the nature of living. Good days, bad days, beautiful weather, days where you call it not so beautiful, but we want to be able to weather the storm, right? So if we get to the bottom, if you had $1 million and the logic in America is, well, if I'm off 50%, I need 50% to get back to even, right? Well, that's the logic, but we like to say math might be the only 4-letter word in America that we don't use, right? So if you have $1 million down 50%, that puts you at 500,000. Yes, a 50% gain from 500,000 is what, 250? So you're halfway there, which means we need 100% gain just to get back to even. And we've even looked at, in fact, situations where we say that looking at people who've been referred to us, by the way, we are accepting referrals in 2023. Thank you very much. Some of those counts have been down more than 50%. In one case, it was 70%. Well, we ran the numbers at 60%, and guess what you need to get back to even? 150%. That's huge any way you look at it. What are your odds? And let's make sure we understand all of these negative numbers only are assessing an account that is static. In other words, we're not taking withdrawals. So Daniel, real quick, talk to us about what happens when we have a serious loss. Like, let's say it's 50% from $5 million. Now it's 2.5. And let's say that the couple is needing to live off of $200,000. I think we can all agree that's a pretty nice income, pretty nice, particularly in retirement, don't have to work, both sold 2 businesses, hypothetically. But the account gets cut in half, so now we're at 2.5. The yield has to what, double to 8%? But play that out a little bit for us so folks can get a sense for if there's not a serious recovery and the withdrawals remain the same, what happens to the account?
Well, so when you go into the income phase of your life and you start taking distributions from your account, those losses become much more dramatic than they did when you were accumulating money. So let's say you started taking withdrawals of 5% of your account in a given year, and you also saw a decline of, in John's example, 50%. So your account goes down by 50% and you took a withdrawal of 5%. So from the beginning of the year to the end of the year, your account has now been reduced by 55%. 50% from the market, 5% from the withdrawal, 55% total. In the next year, you likely still need the same withdrawal that you took in the year before. So that 5% has already been scheduled. Now, since the account is half of what it was, actually a little less than half, the withdrawal that you're taking is not 5% of the account. Now it's 10% of the account. So to get back to even, we have to make up the 55% we declined from the previous year, plus the withdrawal that we have scheduled for that year. So that's another 10% of the account value. We have to make up about 65% of the original account value. So we need our account to more than double to get back to even. If you play that out, because income is like not only needed for a couple of years, needed for the rest of your life, you still need those withdrawals. It becomes very difficult to build back what you lost when you start taking money out, because you're going to keep taking money out. It's just a hole that digs a little bit deeper. Something has to change. Either withdrawals have to be reduced, stopped, or the account will go to zero at some point. It's just a math question as to how long. So those losses become much more crucial when withdrawals are being taken.
So yeah, in the real world, again, you find yourself in a ditch, stop digging. But most of us, in my opinion, too many investors here, they aren't looking at their statements. Some of our peers have said to their clients, don't look at your statements. That is not us, but we won't do that to you. But we want to see where we can keep is it possible we could win by losing less? That's the question. And it's something that we have to evaluate constantly. So here's an example as well, because market's off about 20%. We've been told that, the age-based funds are a good place to be. Here is a well-known Melody age-based fund. That's a place you're supposed to put all your money, right? All the no-load, the least expensive positions. That's just the best place for all the money all the time, right? Well, show us how this played out last year. Market's off 20. This account, I believe, was off this particular Fidelity fund. It's just a representative sample. It's not good. That's not bad. But it was off over 20%. Show us what happens in terms of folks trying to take income and what happens from the standpoint of looking not only at this year or last year, but future years, because our goal is to get you to know that your odds are pretty good. We'll say better than 80%. So that you can stick around to age 100 and you know that you've got enough, the same kind of income that you're accustomed to. So show this how this worked, Daniel, please.
So this on the screen is our planning software. What we do with this software is we take all the information we know about you, your age, your assets, your income, your expenses, and we project it forward. And the goal is to see that we have enough income coming in from all sources to meet your spending requirements for the rest of your life. What the system does is it runs through a Monte Carlo simulation, which is 500 different iterations of market returns, good markets, bad markets, flat markets, all kinds of different markets. Bad markets aren't exactly necessarily bad. They're going to happen. What we want to do is make sure we can weather those bad markets, whatever they are, for a specific asset allocation in our account. The Monte Carlo simulation gives us a probability of success. Success is defined as not running out of money. In this example, given this scenario, this hypothetical people are 86% likely of not running out of money. What I didn't take any actual portfolio holdings, any real portfolio holdings. I just reduced their portfolio by 20%, and I ran the exact same simulation. So what happens?
86% through age 100. That's important to note. Right.
And then what happens if everything else remains the same, but the portfolio goes down by 20%? That's the question. In the same example, the odds of success go from 86 to, whenever this is done calculating, 56%.
Oh boy. Well, when would you like to know that? We want you to know it now.
At that point, we have to make some decisions. We like to be at least at 70% success, really like to be in the 80s and 90s. But if we go down to 56%, we have to make some decisions. Do we reduce income? Do we change our asset allocation? What do we do? There's something has to change here, or at some point we run the risk of running out of money before age 100, which is kind of our baseline for for life expectancy. Not to say that you're going to live to 100, but we want to make sure your money is going to last to at least 100. That way, whether you're here until 90 or 105, you have enough money.
Yeah, yeah. We don't want to listen to the guys who say, well, dad died at 56, so I might make 60. No, sorry. If you can tell us exactly when you're going to check out, then we're good. But I don't think you can do that. And I'm sure you want to stick around to see how this all going to turn out. So we're going to base it. We think it's more conservative to look at a longer time frame, but also to do this kind of work at least annually to kind of have someone looking over our shoulders to see, are we missing anything? And we constantly review these kinds of things with clients. So that's one of the reasons why we are hungry, if you will, for more clients just like you guys. And please listen to your friends and relatives, because I can tell you, unfortunately, most of our peers have access to this kind of technology, but we don't really apply the techniques and the talents and the tools that are available to us. It costs money, and people have to get ready to use it, and then we have to apply it so that you constantly or consistently looking to see how are we doing with our eyes wide open. So speaking of that, Keith, please give us a little intro into your professional background, and then tell us a little bit about AssetMark, and then show us how AssetMark did, the markets did in 2022. We want to hear about what the company's forecast is, but we also want to see how the company, folks, think of it this way. You've been to Hawaii. What do the palm trees do in the wind? They flip, they flop, they don't break. That's what we want your account to do. It might flip, it might flop, but we don't want it to break. And sometimes we have to be in different positions at different times, but who's going to watch all of that? Who's going to make those movements behind the scenes? Or some people are do-it-yourselfers, but they're really hesitant. They don't do this 100% of the time. They don't have thousands of analysts. So that's why we bring companies into the equation like AssetMark.
That's right. Well, thank you, John. I appreciate the opportunity, and Daniel as well. And I believe, as John said, many of you do have investments with AssetMark, so we definitely appreciate that and take your confidence in us seriously. So I thought today what I do is give you just a little bit of background on AssetMark in case you don't know. And then, as John was saying, kind of provide our outlook in terms of what we believe is transpiring in the marketplace right now, a little bit of reflection on last year, because it does provide good context moving forward. And most importantly, really wrap up with where we see opportunities right now. The news is covered with all the negatives going on out there, inflation and interest rates, and a challenging economy, which are all true. But despite all of that, there are still some really attractive opportunities right now where investors are very well positioned to do well. So we want to make sure to leave you with some ideas to take action and talk further with John and Daniel about. So just a little bit of background on AssetMark. We've been around since 1996. So whatever that is, 28 years going on or so. I've been here about 20 years myself. I worked with John and Daniel for, gosh, probably 15 of those years, I'm guessing, guys. So long history with the firm and with John and Daniel. And ultimately what we do is provide a curated, vetted lineup of institutional money managers that all do things in different ways, so that advisors like John and Daniel can sit down with clients like you, do financial planning, understand your goals and objectives, and align your portfolio with the right kinds of investment strategies. So our main focus is really selecting and monitoring different investment managers, making sure that they, in our eyes, are the best at what they do and maintain that capability. And then I work individually with advisors like John and Daniel to really help them understand where these different strategies can fit for clients like yourselves. We manage just shy of $100 billion. We're about 90 something now, depending on the market. So closing in on 100 billion at least. And as of 2019, we have been publicly traded on the New York Stock Exchange. So we started as a little small company when I joined, and now being publicly traded, we've seen obviously a lot of growth and a lot of change, and a lot of thanks to clients like yourselves for trusting advisors like John and Daniel to place your assets with us has contributed to that. So John started the comments today around the beautiful weather we're having here in Southern California today. I assume most of you are Southern California. I think temperatures around here are going to be 75 to 80 today, and beautiful green hills, great time for a hike. But the market outlook is a little bit different. The market outlook's a little bit more lined up with the weather we're expecting this weekend, I think, from what meteorologist John Grace was saying earlier, where the weather's going to change. And from an economic standpoint, there are definitely clouds out there. But is it a major, massive storm? Or simply just a change in weather? And we'll try to discuss a little bit of that, because there has been I'd say a very big dynamic, a shift in the dynamics of the market just in the past 6 to 9 months. Just to throw up our disclosures here, I'm sure you can read that really fast. But as we get into this, what I want you to really understand is that, you know, the challenges of last year were really unique to the environment that we faced, and are similar, though they've shifted as we move into 2023. So just a quick context on last year. It was a really unique year, not because the stock market was down roughly 18 to 20%. Though that doesn't feel good for any of us, right? 18 to 20% down for the stock market is actually pretty normal. That's not an abnormal year for stocks. What was incredibly abnormal was the green bar in the middle you see there under the global bond bar graph being down 16%. Bonds don't typically fall 16% in a calendar year. That was the really unique aspect of 2022. And so, as John mentioned earlier, for an investor that is what we consider balanced or moderate, kind of a 60% stock, 40% bond mix, you see in the black there, that portfolio was down 17%, equally contributed to from stocks and bonds. So if all we're using are stocks and bonds in our portfolio, that's kind of what we're left with there. On the left-hand side, though, you can see those 3-bar graphs starting with the tactical category and commodities and managed futures, which we won't get into details of what those are, but those were 3 areas that did tremendously better than traditional stocks and bonds. They're more unique and alternative asset classes. And, you know, in an environment like last year, you can see there were ways to make money, but it was outside of the traditional stock and bond landscape. So as we get into where we see opportunities for this year, kind of picture this chart here where we've got stocks and bonds on the right. We've got these other alternative strategies on the left. In different years and different times, they're all going to look different from each other. And that's really the point. Our whole point is by combining these together, you create better diversification for clients outside of just a traditional stock and bond, as John mentioned, a passive Vanguard portfolio type of thing. We believe that can be a good component to a portfolio, but it should not be the entirety of the portfolio, because as the bar charts show on the left-hand side, you're leaving a lot of diversification benefit on the table.
Let me jump in here real quick. Keith, go
Sure.
back, please. The point I want to make, a couple of things, folks. We see these gains to the far left. And guess what? That's true not only for 2022. Those 2 positions, along with currencies, were all up in 2008. Not a suggestion, not a recommendation, but proof that the traditional static portfolios certainly can't be like that palm tree there, or if they are, they're just in one direction and it's all in the red. We want the palm tree to bounce back and forth between these asset classes, because how does it go, Keith? This year's darling is next year's dog, and vice versa. But my real point is, it's interesting to note, both in 08 and 2022, the same positions that maybe you wouldn't own any other time happened to show up real well in the positive side back in 2008 and 2022. And that's one of the reasons why we talk a lot about greater diversification than 2 or 3 asset classes. Maybe it's 7 legs underneath your portfolio stool. It just reduces the odds of them all being down at the same time. Thanks, Keith.
Absolutely. And just to belabor the point for a quick second here, this shows the range of returns for stocks and bonds going back to 1976. And, you know, quickly you'll see there's very few negative years. You can see what 1, 2, 3, 4, 5, about 7 or 8 negative years there. And it might be a little bit hard to see the difference between the light blue and the dark blue. But in every year except for last year, when the light blue is down, that's stocks, the darker blue was up, meaning bonds provided good diversification from stocks. Last year, for the reasons that we'll talk about on the next slide, bonds were down and stocks were down, making it a really, really unique year. In fact, the worst year for a 60-40 portfolio dating back 45 years. That's how unique last year was. Why was that? Well, as we well know, inflation crept up rather rapidly through the latter half of 2021 into 2022. And the way that the Fed puts out that fire is they ratchet up interest rates. Think about it like a fire hose putting out a fire. They have to turn that thing on, they have to pump it really hard, and they have to use that to extinguish the flames. So the bar, or the chart rather, on the left-hand side, this black line for 2022, shows you how significant the rate increases were last year compared to other rate increasing cycles going back to I guess the mid 90s was the furthest back. So the steepness of that line shows you how fast they had to pump that water to try to extinguish those flames. And because of how quickly and significantly they had to raise interest rates, that's what led to the severely negative year for fixed income. So as we think about the return for bonds on the right-hand side, you see how deep that red decline was that last year. And that's directly related to the speed and the significance of the Federal Reserve raising interest rates. Now, they may not be done raising interest rates. Whoops. But one of the questions we have to ask ourselves is, are they pumping water fast enough to begin to extinguish the flames? Is what they're doing by raising rates having an effect on lowering inflation? And it's not a direct relationship where it happens right away. It does take some time for the rate increases to hit the markets, to kind of work their way through the system, and for us to really tell, is this enough? Is this helping? What we're beginning to see is that inflation is starting to peak and or roll over in many areas, not all areas. Wage growth specifically is still on the rise and probably will stay around. Living expenses, especially rent, is still on the rise, and that's a lot of supply and demand issues. But a lot of the other areas have begun to kind of roll over. So what our conclusion is as a firm, and many of our money managers agree, is that the Fed's ability to turn that hose on, pump water hard and fast, is not putting the flames out yet, but it is beginning to do so. So what that means is inflation likely has peaked in most areas, and it may not come down right away, but we should not see the continued rapid increase that we saw going back a year ago. So when I said earlier, there's a big shift in dynamics going on, that's really what I was referring to. Last year, the dynamics of the economy and the markets were really related to the Fed having to turn that hose on fast and furious. And it just threw everything out the window. You know, bonds went down because of that. Stocks went down because the fear was, with the Fed ratcheting rates up so quickly, it would put a chokehold on the economy and slow down growth and push us into a recession. That hasn't happened yet officially. We always find out in hindsight. So maybe we're in a recession now, although I don't know if you guys have been out to any malls or stores or anything like that recently. It seems like wherever I go, everywhere is still packed and people are spending money. So it doesn't feel very recessionary if we are in one. But that was the reason stocks went down as well. So as we begin to see inflation decrease, or at least level out, the hope is the Fed does not have to raise rates to the same extent, and hopefully maybe not at all at some point. And that should create a better environment for economic growth, and then also, of course, the stock and the bond markets. So as we look forward, what are the implications of all of this? Well, last year, if you held bonds, most of us have probably heard, correctly so, that bonds are safe. They're safer than stocks. They're our defensive money. Well, our defensive money, once again, we don't expect to fall 16%. So again, that was really unique. But the other side of that coin is that now, because interest rates have risen so much, now bonds are actually incredibly, incredibly attractive. So if you look at the dark blue bars here, you see here, I'll just pick investment grade credit just because it's in the middle of the page. This is the investment grade credit, means the bonds issued by General Motors and Ford and AT&T and Verizon, those kind of companies. A year ago, they were paying you as an investor about 2.3%, which is not really a whole lot considering the historical yields on bonds. Because of all of the rate increases last year, those companies issuing their bonds had to issue them at higher interest rates. Therefore, today, those very same bonds from those same companies are yielding on average almost 5.5%. So they've more than doubled in the past 12 months. So putting new money to work today is incredibly attractive because those yields have spiked up so much. On the far left here, I want to point you to something, the short-term treasury category. Our investment team believes this represents the best risk return trade-off. In other words, the best return for level of risk taken, best bang for your buck is another way of saying it, in the entire investment universe. And that is because short-term treasuries, there's two things. One is a treasury bond issued by the US government is backed by the full faith and credit of the US government. Okay, so they're the most secure investments in terms of the credit backing the bonds. Short means they're short-term in nature, meaning they're very, very liquid. They're very, very protected from rising interest rates. So essentially, it's one of the safest places you can invest outside of cash, money markets. A year ago, nobody bought them. 12/31 of 2021, so going back a year and a couple of months, short-term treasuries are paying you 0.2%. Okay, that's nothing. Today, they're paying you, it's actually higher than this, but as of 12/31, 4.5%. 4.5. It's actually, we have a portfolio, a manager who builds these. The yield right now is about 4.7%. So for very, very secure and safe portfolio, still has some volatility, can go up and down a little bit, but in the big scheme of things, on a scale of 1 to 10, this is like a level 1 of risk. Stocks would be a level 10 as an example. To be able to earn 4.5% on your money is really attractive. So we see a lot of investors with excess cash, maybe cash they've built up in the bank, they don't know what to do with. The stock market seems scary. Last year was kind of scary. This is a great stepping stone to begin putting that money back to work and earning a very, very healthy yield. So one message as far as what the opportunities are coming out of 2022 and into 2023 is bonds across the board, specifically short-term treasuries being one of the most attractive areas. So as we think about the stock market, I actually want to go ahead one slide here. So that was kind of the bond market. Now the stock market is a bit different animal. As I mentioned, we expect a lot more of those ups and downs. And on the right-hand side, I want to point you to the numbers there and kind of walk through that. Because we're always told not to use gambling analogies in the markets and investments, but I'm going to paint the perspective that when you do go gamble somewhere, typically your odds are not in your favor, right? We play it for fun. Typically, the odds are not in your favor. When it comes to the markets, the odds are actually in your favor quite dramatically. So the first category there in the top right shows the economy. And what it's saying there is that on average, when we have a recession, the recession lasts 10 months and the economy shrinks by about 2.5%. On the other hand, when we have an expansion, those last for 69 months. That's almost 6 years, right? And the economy expands by 24.6%. So it expands by, I don't know what fold that is, a massively different amount than it contracts during a recession. And in turn, the return that we earn for the portion of our assets invested in the stock market goes hand in hand with that. So during bear markets, which are usually during recessions, the average bear market has lasted 13 months, so a little over a year, and the total return is a negative 33%. Right? That's painful. It doesn't feel good. But that's the ticket to the ball game if we want to play, so to speak, and earn what can happen during the bull markets, which don't just last 13 months like bears. They on average last 67 months. So again, about 5.5 years. And during those bull markets, the total return on average is 265%. So if I were to say, which one do you want to bet on, the numbers in the orange or the numbers in the blue, clearly the numbers in the blue are in our favor. They happen the majority of the time. And when they happen, they're significantly, significantly positive. So the reason I point that out is that many investors wait till they feel good to put assets to work. And the problem with that is on the left-hand side, in that the market recovers before the recession ends or the bear market ends. Okay. The market has a very funny way of reacting before all of us as individual investors, subject to reading the nightly, the paper and the nightly news and whatnot. The market has already bottomed 6 months in advance of the news sounding better. So when we feel better and we say, hey, I've got this extra money, I now want to put it into stocks, John, but I'm going to wait till I feel better. You're going to feel better after the news looks better, after we start hearing things that sound more positive. And by the time you've done that, you've already missed the big bounce off the bottom. So it's really tough because we're all prone to making emotional decisions as investors and human beings. It's innate in our nature. But the reality is the market responds far faster. It falls while we still feel good, right before the recession happens, like it did back in late 2021 going into 2022. And it also bottoms well before the news is positive.
Yeah, let me jump in and make a point here, folks, that to Keith's point, it's interesting that when the market starts taking off, we find one pattern that seems to be pretty consistent, and that is the majority of the gains happen in the first 6 months. So, typically we get ready to get back in the water at the end of the year. Oh, it was a good year. Well, if you weren't in for the first run, like starting March 9th or so, 2009, that was a great run in the first 6 quarters, 2 quarters after that. And then it finished fine, but most of the gains were on at the very beginning of the uprising.
John, that's a good point. And I want to, oops, keep clicking the wrong way here. I want to talk about this for a second. And this is something that you've probably seen from John and Daniel before. It's just a fundamental investing challenge that we all face because we are emotional human beings. And that is that we tend to buy again when we feel good. Once confidence is built, once we feel enthusiastic, we see people making money, we have that fear of missing out, right? That's when we feel like we want to buy. And contrary to that, we feel like we want to sell once we get fearful, panic, despair, doubt, all that kind of stuff starts to sink in. We vacillate between these emotions. And what that leads the average investor, typically an average investor not using a professional financial advisor, it leads them to buy at the wrong time, high, and sell at the wrong time, low. You've all heard buy low, sell high. Then why, as emotional investors, do we wind up doing the very opposite, right? It's just because it's so uncomfortable to not participate in the upside and to sustain the downside. And the reality is that's just the ticket to the ball game to make the money that the equity markets can deliver over time. One of my colleagues says it best. He says that investing is like a bar of soap. The more you touch it, the less there is. Which I think is one of the best analogies, just to say, leave it alone, let the markets do their thing. If you have more on the sidelines, put it to work and let the market go up and go down. But we know on average over time, the market goes up way more than it goes down. And just to hit the point a little bit more, this shows the challenge with trying to time when to get in and when to get out. It shows an investor in the dark blue there that got out back in 2009 after that big financial crisis drop. And they got back in after the market had recovered, when they felt better. So the investor that stayed in their $1 million, 20 or 15, 16 years later, their $1 million by staying invested the whole time was now worth 4.5 million. Whereas the investor that got out after the big drop and got back in after the market had gotten back to even, their $1 million was worth 2.7. So there's a lot of things that can cause challenges to people's retirement, but that's about a $2 million gap that can significantly alter somebody's retirement plans just because of an emotional response to what would be termed a fairly normal thing to happen in the stock market.
Yeah, and let me say, in the real world, we met Daniel and I with a referral, and we said, gee, we're looking back. Most people don't. The advisors don't either. I'm sorry, we don't. And we see that your 401k is it's not quite, this was last year, back to where you were in 2008. What happened? She didn't have an answer. So she didn't see anything that, why that was. it turns out it took a little more dialogue, a little more study. She was in the market enjoying all of the upside, went through 2008, went to cash, and the only way she felt comfortable getting back in was in bonds. So although she's been making contributions for, 14 years or so, because she got out and then didn't have a different game plan than let's say she was aggressive on the upside and conservative on the reverse side. She's just getting back to where she was 14 years ago. And of course, after inflation, to Keith's point, it's not the same number. So, but we're not saying stocks for the long haul. We are saying pay attention to these things. And we are saying, I like the ticket idea, your ticket to the ball game. We've got to figure out what gives us better odds, but what kind of work do we need to do so that you can achieve the results you're trying to achieve? And I think it does require consistent reviews.
That's right. Consistent reviews, engagement with a professional who can guide you. And from an investment perspective, what we try to do is build a portfolio with different types of investment strategies to help you navigate these markets emotionally. So as we face volatile times, if to John's point earlier, if we don't experience as much downside, we don't feel as pulled to make an emotional reaction, and we keep more of our money in the market, we dig a shallower hole, so to speak. And when we dig a shallower hole, like Daniel and John's slide at the beginning showed, we can build back on top that much quicker. So the way we think about doing that is by introducing to investor portfolios 3 different types of strategies that I'll explain. The first strategy is what we call core markets. These are the strategies John mentioned, Vanguard, American funds and whatnot, which we have, and we think they're great strategies. But what they do is they will allocate to a certain amount of stocks, certain amount of bonds aligned with who you are as an investor, as far as your risk level goes. And they will pretty much stick with that mix. This is the traditional way of investing. Now, if you are going to not look at your portfolio, not react to your portfolio, not need money off of your portfolio, like Daniel was saying earlier, these are great strategies. They tend to be a little bit lower cost. They tend to be more simple, passive, and they will get you all the upside of the markets, but also the downside. So we combine core market strategies with these other 2 categories to help provide a different type of return, different type of risk management, and to create ways to buffer your portfolio, kind of put the guardrails up on the bowling alley, so to speak, which my kids are 12 and 15 and they still want them up. I'm like, guys, at some point you just got to learn how to bowl. But in investing, we can put those guardrails up. So tactical strategies, you saw the box in the first slide, that those on average were down about 9% last year. Tactical strategies are able to maneuver. They're able to be flexible. If they're driving down the road and there's a pothole, they can swerve out of the way instead of running right through it. Diversifying strategies are very defensive alternative strategies in many cases. Those are the 2 far boxes on the left on that first slide, the managed futures and commodities, where many of those strategies actually made money last year. So they're able to provide defense in a very different way. The analogy I use to help people understand this is if you think about driving a car, you have a gas pedal, a steering wheel, and a brake. In this context here, core market strategies can be thought of as the gas pedal of your car. If there's no traffic and the weather's perfect, you just punch your gas, you're going to get home the fastest. But what happens when there is a pothole in the road? You want your steering wheel, i.e. the tactical strategies, to be there so you can swerve out of the way and avoid that. The diversifying strategies then can be thought of as the brakes, really designed to protect you from the crash, which, as evidenced by that managed futures up 27%, they helped to defend from the crash last year. So in the same way that we use those 3 elements to drive a car, and each of us drive differently, we're different kinds of drivers, we're maybe driving in different road conditions. We use different amounts of these 3 for investors based on who they are as an investor, based on what your individual goals are, based on what your income needs are, and so on and so forth, but also based on our and John and Daniel's assessment of what the road conditions are out there. What are the economic conditions that we're facing? Do we need more brakes or need more gas, et cetera? So in most of your portfolios, you'll see some combination of these 3. And in many cases, they will be adjusted based on you changing as an investor and or as the market dynamics continue to shift. So I think just as a summary, where we're seeing opportunities, number one is obviously in fixed income with yields up, really, really attractive yields now to put money to work. Number two is, stocks are, well, they're doing better this year so far, but they were down 20% last year. There's some really good companies still making really good money that were, 20% or more down in a year like last year. So there are opportunities to take advantage of that. And then just having these different kinds of strategies in your portfolio so that when something is zigging, something else is zagging. That's really what these three different approaches here are all about. So John, I'll wrap up there. And if you have anything to add or any questions anybody wants to ask, be happy to take a few.
Well, let's open up for questions, please. We're doing great as far as time is concerned. And I know there's some of those folks we certainly know, and you guys have great questions. So fire away. If you do, you need to take yourself off of mute. And, yeah, any questions you have, please. None? Really? I'm surprised. Gil?
Oh, with the present administration, how do you think of your investments are going to be in this year and next year, based on what was said the other night in the State of the Union message?
Yeah, politics are always an interesting topic. The reality is whether it's a Republican or Democratic, government, the impact to the markets is really not based on that. It does create a lot of noise. It creates a lot of emotion. At the end of the day, good companies make money and they find ways to pivot. They find ways to adapt regardless of the administration. So I don't think that what Biden has to say or his views or anything like that versus anybody else has any impact on what our managers are doing. I think bigger than that, though, maybe to talk about geopolitics, Ukraine and Russia, that's created some interesting dynamics, not because of the administrations per se, but because of, energy prices and just what's happening to the European economy. So a lot of our managers, because of that, have been actually shifting more towards the US over international positions, still maintaining some international. But I would say by and large, across our 30 or so managers, the majority of them are more domestically weighted than they are international, just because of the geopolitical war situation going on there.
Okay, thank you.
Yeah, and overview, it's kind of interesting. This pattern seems to be holding. The market doesn't like uncertainty, and when you have the Congress and the House and the White House, where they're completely stalled, guess what the market does? It loves it because there's more uncertainty. So if you really want the government to work and get something done, you don't want certainty. You want uncertainty. So it's a very interesting thing to observe. And by the way, we've looked at the numbers in terms of whether it was Democrat controlled or Republican controlled. Not much difference overall. A slight the Democrats when they were in control did slightly better than the Republicans from what we can see that we've studied. But again, at the end of the day, it's about it being, these guys are at odds. Nobody's agreeing to anything. The markets love that more than they're really working together to make America big and better again. Daniel, there's a question on REITs. You want to take that one?
I'm gonna turn it over to Keith. Keith, what's AssetMark's outlook on REITs?
Well, our strategists can use a variety of different asset classes to build portfolios. Real estate can be one of them from time to time. So certain of the managers, firms like JP Morgan and State Street, do have exposure to REITs. It's never going to be a big allocation. Obviously, with higher rates, it makes a more challenging environment for real estate. But by the same token, it's creating opportunities because there's a lot of high flying markets out there, commercial and residential, from the past few years that have gotten hit pretty hard now since rates have increased. So I know there are a lot of firms out there that are much more optimistic about being opportunistic in real estate. And we're starting to see some other firms include allocations there. We're talking less than 5% of a portfolio on average.
Yeah, I was speaking just a couple of weeks ago with one of the folks at home office, that's LPL Financial. And I got what we thought was some very good news, and it actually follows in line with what we've been saying from the standpoint. We want to see more alternative type investments, okay? And it looks like they are forthcoming. So this is one of the things that we would say, it's good to have the ability to keep some powder dry. And sometimes the opportunity comes where it doesn't have a 40-year track record or even a 5-year track record, but the concept is solid. And for example, when we started talking to many of our clients about not residential REITs, but more healthcare oriented, we think the winds continue to be very strong for those kinds of properties, primarily because what do we have? 10,000 people a day turning 65 through 2030. Well, that wave is not yet crested. And how much more money and time are we spending in front of these medical facilities where the prices are just mind blowing? And then you have to get your car out of pocket in the parking lot. So that's not going to stop, but we'll continue to keep our eye open for different vehicles because, and we'll talk about this more on the 13th, when we look at some of the institutions and endowments, we find that not to say that this is something you can do because you really can't. We are retail investors. The SEC and the FINRA imposes its will on us. But I think we can learn a lot from the institutions and endowments who frankly can do just about anything. And again, there's no one pattern, but some of them have put together some really, they actually tell you, what we used to do, what we're doing now, and why we think this is different. You usually don't see that. But the bottom line is it's more legs underneath the portfolio stool. We never know which one's going to go up. We never know which one's going to go down. But if we're in a number of them, certainly that's a stronger foundation than 2 or 3 legs under the stool. And in many cases, frankly, we've got a lot of people with only one leg. All their net worth is tied up in fill in the blank. That's great on the way up. It hurts on the way down. Any other questions? We're doing great for time. Appreciate you all here on this beautiful day, taking time with us to see what we're doing about our money and what we can do no matter what the markets do, which we think is important.
I have a question, John.
Yes, sir.
What about water rights? When you talk about in real estate, I've always heard that people talk about investing in real estate.
Right.
I've also heard that companies are starting to buy up water rights because of the shortage of water throughout the United States.
You see anything there with positioning, Keith? Good question.
No. Everything we invest in is liquid, funds, ETFs, and stocks where you're not really getting water right exposure.
There are ways to do it. There are exchange traded funds that really specifically focus on water resources and that pretty much industry. I don't know what the returns were like, but that is something that there could be some exposure to. It's not something I've seen any real company talk about in depth or focus on. I don't know what kind of opportunity there really is there, but that is something we could talk about offline, Donald.
I guess what my question is not so much opportunity. How does that affect? We talked about political, we talked about the economy, we talked about all these other things that affect portfolios. How do you see that affecting?
So that's probably more of a global topic as opposed to like a 1-year thing or a short-term thing. I think the answer is we'll see. No one knows. It's kind of like looking at the bond market last year. We all expected interest rates to go up, but no one really expected to go up for them to go up as fast as and violently as they did. So if it becomes an issue, we won't know until it becomes an issue. It's one of those things you don't know. You don't know what you don't know, and we just don't know what the effect's going to be if it becomes a big problem.
I want Keith to, we talk about one of the positions we do like relative to technology. And to your point, Donald, it's a great point. I don't think we've seen anything yet where anyone's addressing that. On the other hand, if any of our clients, we like to tailor and customize as much as we possibly can. And sometimes people want to put X number of dollars in a position where you have an interest in. If you tell us that, we'll do some homework. We don't have anything in our bag of tricks, right? They say, oh yeah, we've got one of those. Here it is. No, we don't. But if that's something that's important to you and you say, hey, I want to allocate X number of dollars to a position like that, then we'll do our homework and see what we can find. But so Keith, what you do have in your bag of tricks is one of the things that we do like. Technology is sometimes the canary in the coal mine, right? It's the first one to peak and then fall like a rocket ship all the way down to the floor. And in fact, some are suggesting that tech could be off 90% from its high. We'll see. Nobody knows. As I say, it's not about the prediction; it's about the preparation. But there is one program that we have taken a look at. It does require a larger amount of money. But talk about this one, please, Keith, from the standpoint of how AssetMark is using a fund that is making some very, we would think, smart suggestions or positions that got hit hard last year. But that's where it becomes more interesting, because if you want gains and you can catch that wave at the bottom, we might see some of those gains again as we're riding the next wave. So tell us about that, please, Keith.
Yeah, I think all the topic we're talking about really is about, identifying different themes that drive returns, right? Whether it's water conservation, water rights, whether it's, e-commerce, whether it's healthcare, innovation, things like that. So we do work with a couple of managers who purchase individual stocks for their portfolio that are targeting these innovative themes. Gene mapping as one example. As a way of addressing different healthcare related issues. So there's a couple years ago, it cost $100,000 to map genes, which would lead to treatments for cancers and whatnot. Today, it costs about $1,000. So all this innovation creates opportunities for companies that are targeting whatever it may be, targeting healthcare. E-commerce has been a big theme as well. Certainly, there are themes in the kind of the environment area around fuel efficiency, around water conservation is actually one. I know it's different than the question that was asked, but all those different themes are targeted by these companies that are looking for innovative companies. A few years ago, the best example of an innovative company would be something like Tesla. That was a big holding in their portfolio going back 10 years ago because they were innovating their space. Right now, they have competition. Other companies are innovating different spaces. And so these managers are able to really try to, with their research teams, identify what the big themes are going forward the next 5, 10, 20 years, and what companies are best positioned to take advantage of those themes, and then purchase them before they become, the $1,000 per share stocks like we've seen from Tesla, but get in on the early end. So as John said, they're much more risky, much more aggressive kinds of strategies. If it's appropriate for you, it's probably appropriate for a small percentage of your assets because it can go up and can go down quite big. But over time, the idea is that if these innovative themes do take hold and these companies do participate, they can create outsized returns for the right kind of investors.
Beautiful. All right. Well, we're right at 1:02. We expected to be together about an hour. And I think we have accomplished that. I think we covered a lot of ground. We do want to thank you for joining us and thank you for working with us. And please do not be afraid to open your statement. And we're happy to review with you exactly how you did and what you can do to keep your odds above 80%, to get to 100 and have the kind of income that you're used to. And by the way, one of the things that we have found is when we look at folks' accounts, we might be pleased with the decline not being as severe as the overall market. But as Daniel showed, we also look to see what this decline might do in terms of being able to have the same kind of probability for success through age 100. And sometimes what we can see is by adding cash, and a lot of people are sitting on cash, and there are ways to meter that money back in somewhere. It just increases your odds. Just as we would say, if we've had one referral, we'll always remember them. This husband and wife bought matching motorhomes. We never understood that one. But we want to make sure that people look at what they might do with cash before they put it on the bottom line to see what it might do to their odds of success. That way you're making more of an eyes wide open decision. And that's what we're all about, trying to help you see the options, make sure that you're making intelligent decisions and you know what you're doing and why. So we are accepting referrals and please keep your eyes and ears open for those friends and relatives because we think they're going to have good reason to have a lot of complaints. That's what we are foreseeing. And we want you to be able to say, hey, let's get you a second opinion. I think I can arrange that for you. And please finally put the date on your calendar, noon Thursday, the 16th. We'll be picking up with workshop 2. If you missed the
Repeat
announcement,
it.
we'll be talking about greater diversification in general, alternative investments in particular. So on behalf, thank you very much.
Repeat the date.
March 16th, noon, Thursday, the 16th at noon. We'll be getting you announcements about that, but I thought we'd take the time to make sure you had it while we're all together today. So yeah, please join us wherever you are. You'll be glad you did. We'll be glad you did. So thanks again, Keith Stemple, and I couldn't do anything.
Yes, thanks, Keith, John, and
Keith. Thank you, Keith.
Thank you all. Appreciate it.
Without Daniel Medina here, our main math man, to make it all come together and make sense, and we can see it, and then we know what we're doing. So thanks so much. Enjoy this beautiful weather, and we look forward to seeing you again soon. Bye-bye for now.
all right.
Bye.
Bye-bye.
New Mexico, where it's not so
Mexico.
beautiful.
Sounds good.